Okay, here is a simulation for a borrower looking to buy a $300,000 condo. They want to put $100,000 down and just to get their mortgage payment down lower. But in this all-in-one scenario, there is a way to get your payment even lower than that and putting even less down. So in this situation, we're going to set this loan up as a $300,000 purchase with a loan balance of $270,000. Now, they said they wanted to put $100,000 down. You can put as little as 10% down on the all-in-one situation. So, $270,000 loan amount, we're going to compare it to a purchase loan on a conventional at 6.125, 30 years. So in this situation, let's say borrower earns about $15,000 a month after taxes. We're going to say monthly, right? And then as far as expenses, taxes and insurance, we're probably looking at about let's say $250 a month. Now, this simulation counts the mortgage because it is an all-in-one loan and it just draws interest only out each month, so you don't physically make a mortgage payment. All right, so we're going to look at the monthly expenses aside from the actual mortgage and taxes. And let's say monthly, actually, let's just go down to about 5,000 left over. Let's say the expenses monthly, which would include car payments, eating out, gas, utilities, all of that. Let's say the average monthly expenses are about $8,000 for this scenario, leaving $5,100 left over. So we're going to calculate these results just based on that situation. As you can see here, if all they did was run their income into this bank account, because it is an all-in-one loan, you have your bank account and your mortgage attached, versus checking and savings, you'd have a mortgage and checking. All right. So without making any additional loan payments, any extra payments towards principal, your normal bills, your normal budget, everything going out, all you were doing was leaving your excess disposable income in the bank account and not spending it. And by doing so, you were paid off in 4 years. And when I mean paid off, you will have $270,000 in your all-in-one account available to use. So let's look at this summary here, the pay down summary. Your average monthly payment, which your monthly payment is interest only. So on average over that 4 years, you were paying less than $1,000 a month towards your mortgage, and that was interest. And on average, through the month, through the 4 years, you were contributing about $5,600 a month towards principal, and you weren't making extra payments. And that leaves you at a 1.18 effective APR. No way in this world are you ever going to see a 1.18 interest rate on a mortgage ever again. Here's your comparison. Your monthly payment on that would have been $1,640 a month. Your average principal reduced each month was $750, and we're at a rate of 6.125. All right, now this is going to blow your mind because the interest rate we used to start this loan was 8.3. This 8.3 rate is based on index, the 30-day average index for so far, which was 4.3 at the end of September. And then the margin, which you can buy down all the way down to 2.5 if you wanted, but the base margin is 4. So your rate was 8.3. How did we get to 1.1 for an APR? Well, APR is smoke and mirrors. It came to light on Truth in Lending back when the big bubble and there was all kinds of bad loans going out. All of a sudden, we wanted to make sure the consumer knew exactly how much they're paying for the money they're borrowing. So the APR was required on every marketing piece. The borrower needed to know how much they're spending ultimately. Well, the key number in APR, the key calculation is time. Most APRs right now are figured over 30 years. We paid this off in 4 years. So with a much shorter time frame, your APR was all the way down to 1.18. Now, lenders will play smoke and mirrors with this. They will offer you a rate today of 5.5. All you have to do is pay $25,000 in points to get you there. But because it's over 30 years, it includes the loan amount, your costs for the loan and time, then it spreads it out. So maybe your APR only showed 5.9, right? Rate of 5.5, APR 5.9, which is lower than the average marketed interest rate out there of 6.25 or so. So you're like, oh, that's still a great deal. But if you paid that mortgage off with your 5.9 APR in just 4 years, or if you refinanced it in 4 years, your actual APR, if they come all the way down to 4 years, is probably 15, 18%. So that's how that works. And that's how, by doing this type of loan and manipulating the interest on a nightly basis, you have 100% control of how much this money is going to cost you. It's not a set thing. So let's go back to the results. And what I want to show you here is, remember, in this scenario, borrower wanted to put $100,000 down to lower the payments. So we put $30,000 down to close. After we close, after the account's set up, borrower then can transfer the other $70,000 into the account, and they have access to it. And I'll show you that in a second. But let's calculate the results based on putting that $70,000 into the account. We knocked over a year off of the payoff time. Now we're looking at 2.9 years. And now let me show you this paydown table of what really happened here. In month 2, we transferred $70,000 in there. Now, this is what's available each month after they take the interest-only amount out on the 21st. So as you can see, in month 10, they already have $113,000 in principal on this loan. And they have $113,000 in the account available to wire. It's a bank account. You'll have a debit card, checks, you can do an ACH, you can do direct deposit in, set up all your bill pay to, come out of this account. Look how much principal paid on a standard 6.125 30-year fixed loan. At month 10, you've only contributed $2,600 towards principal versus the 113. Now, if you would have sent that $70,000 to the mortgage on that standard one, so now you're at 72. Great. 72,000 versus 113, still a massive difference. And when I say available, you could use this at any time. Let's say you wanted to start investing. Let's say we were going to do DSCR loans for similar condos because you like this condo, it's got a good return. And when we do DSCR, debt service coverage ratio loans, you don't have to show income. It's just based on, will that home rent for 125% of what the mortgage is. So if your mortgage is $1,200 and your rent is, you're getting $1,600, $1,700 a month in rent, that would qualify to get you the best terms and rates for a DSCR loan. So let's do that real quick. Now, they could choose to do this or not. They could choose just to be happy with it being paid off in 35 months and having that money sit in there and available the whole time for a rainy day, for emergencies, or they could start turning this property into an investment bank. So we're going to do a future one-time expense. Let's say we take $75,000 out. That's 25% down on a $300,000 condo on a DSCR. And let's say we do that in month 12. And let's calculate. So a year after we start closed, you're going to have your $270,000 back in there. So your original property still paid off. And you'll have used $75,000 to pick up another property, which you're earning rent from, you're getting appreciation from it. But let's show you the magic here. Let's do that multiple times. Let's go 75. Let's buy one each year. Let's say it takes you a year to buy it, get it set up, get a renter in it. Let's do month 24, and let's do another one in month 36. And we will calculate that out. So now 6.3 years from the time you close on this loan You'll still have $270,000 in the account. And not only will your current primary home be paid off, but you'll have three other condos generating income for you. Let's go look at that pay down table. So we see month 12, we took 75,000 out there and it grew back. Month 24, took $75,000 out there and it started growing back. Month 36, took it out again and it started growing out. Now, we're just, for simplicity's sake, we're just going to say that those properties are breaking even. But we know if you're generating 125% of what the mortgage is, you're going to be getting an extra $300 or $400 minimum in return on these properties. And that would go in and pay these off even faster. So that's pretty much the basics of why you would want to do this loan over a standard purchase loan. Same requirements. It's based on conventional guidelines. You need at least a 700 credit score. Again, 10% down for purchase. Cash out refi, 20%. If you're purchasing an investment or a second home, it's 30% down. And then cash out refi on those second home and investments can be up to 70%. So this is a great product for people who are good with money, have disposable income, investors who have properties and want to create a war chest or working capital account. This is the ultimate way to do it. So if you have any questions, let's jump on a Zoom and dig deeper into it.